Namibia, a land of contrasts. As one of the top 50 largest countries in the world, it's also the second most sparsely populated nation with only 2 million people. But despite its small population and harsh climatic conditions, Namibia is a country rich in resources. It's the world's 6th largest diamond producer and recently revived its uranium industry, making it the 2nd largest uranium producer in Africa after Niger. Agriculture is dominated by the beef industry, but there are inroads in the north where government is ploughing in money to improve food security into what is mainly a subsistence farming area. And while the country celebrated its independence from South Africa some 20 years ago, it remains tightly connected to the Southern African powerhouse, making it vulnerable to economic and political disruptions there. Like other commodity-driven African countries, Namibia faces a challenging year ahead. Economic growth is expected to slow to 1% this year, as the global economic growth rate drops to 0.5%. And this slowdown means the country's 2 top foreign exchange earners will also see a loss in revenue. The heaviest blow will come from the diamond industry, where output is expected to halve this year, and analysts say by 2010, production will come to a halt.
Namibia as an exporting country, I mean, we're still an exporting country. We export diamonds, we export uranium and copper, for example. And all the prices for those commodities actually been affected simply because there's no more demand for as high demand as used to be for those commodities. And obviously now not having that demand, we'll start producing less, and therefore the economy will start growing much slower than it was doing before.
There are 2 drivers for this lower economic growth rate, and the one is especially the diamond mining industry. The BS Marine already indicated that they will basically terminate the offshore production for at least, I think it was initially indicated up to the end of February, and I think there are indications that that will continue based on what's happening in the rest of the world. And the other one is tourism, and as you will understand is that holidays is the first item that you will cancel and cut out of your budget when you are under financial stress.
And of course, this loss in revenue impacts the country's reserves.
The way we measure our reserve, whether it's sufficient or not, basically is more in terms of our currency bag, because in terms of our currency bag, we have to keep sufficient reserves to cover our domestic issued money in circulation, which is is sufficiently covered. We're talking about our reserves now at $14.5 billion.
Namibia earns 20% of its budget revenue from the Southern African Customs Union's pool. But South Africa's Finance Minister Trevor Manuel says countries need to buckle up, as South Africa's transfers to SARCO members will drop by 1 billion rand this year. To help stimulate the economy, government will continue with its infrastructure plans and aims to increase civil servant salaries by around 25%.
Fortunately, the government will be fairly expensive. We expect that amount that they want to spend additional on salary increases will be roughly 3% of GDP. So, and basically that will get the economy to a positive growth rate. If they would have continued on the fairly conservative approach of the last couple of years, then we would have been in serious trouble. What is worrying is that that salary increase is not a once-off story. I mean, it has a permanent impact. So basically, they have to fund 2 billion plus in the years to come. So revenue is obviously a big challenge for them. On the diamond side, for instance, if you just look at the amount that the government received from diamonds in terms of revenue, royalties, and dividends, which is around 800 to 900 million. And I think we can expect at least a 30–40% decline there. So you can imagine that the fiscus will be under fairly large pressure. And then you have SARCO as well, the SARCO revenue pool. Trevor Manuel already indicated that he's a bit concerned on what's going to happen. He specifically referred to Lesotho, not so much in Namibia. But I mean, the SARCO is our largest source of revenue. Last year it was around 8 billion. I think it will be about 5% lower this year.
And another major concern is that while this income from SARCO is at risk, Namibia also faces a tough decision in terms of its trade agreements. If it signs the economic partnership agreements with the European Union, it risks threatening trade ties with South Africa.
Currently, most of our production goes to the EU, In the case of beef, it's around about, let's say, 80% of value. In the case of grapes, everything's going to the EU, minerals, most of it, and most of our fish as well. The main concern, which was initially put on the table, is the fact of regional integration. If you go back to the Cotonou Agreement, where it gives you the blueprint of how the EPA should look, it specifically states in 2 articles that the EPA should build on existing regional integration initiatives. And in Southern Africa we have got 2. The one is SADC and the other one is SACU. Now SADC is already split in 4 because of different configurations where the countries are negotiating EPAs with the EU. Now the second one under fire at the moment is SACU. Now if you go through with the EPA, then you go against what was proposed in the Cotonou Agreement to enhance regional integration, and in this case it will just precisely do the opposite. The most favored nation clause, that's one of the other problems. It means that in any case where SACU as a group negotiates a preferential or free trade area with someone else, automatically the EU will benefit from that. And I mean, it's a question of you are doing something now that you can benefit in the future without doing anything. I don't think that's fair against developing and African countries in particular.
But it's not all doom and gloom. There might just be some relief in the commodities sector. Uranium is one resource where there is still global demand as the world moves away from fossil fuel energy sources.
There is hope because as you might know, we are the 3rd largest country in the production of uranium, and we have quite a vast deposits in this area, although the prices again are affected like of other commodities.
There are areas, pockets of optimism, particularly in the uranium as well as gold areas. We are looking at these sectors with great interest. Secondly is the area of infrastructure. The Development Bank and other financial institutions in a consortium supported a $3 billion worth of project in terms of power generation. In preparation for the upturn, there was a groundbreaking ceremony of a major cement plant that will be producing 700,000 tons of cement annually. It's an investment again of 2.5 billion Namibian dollars. Later this year, we'll probably see an announcement of some 4+ billion Namibian dollar worth of investment in the uranium sector.
The uranium space in Namibia is dominated by 2 players, Rio Tinto and Paladin. Paladin owns a major share in Australian-based explorer Deep Yellow, who says its financials are sound and mining uranium still makes good business sense.
We got to a stage where uranium went down to $6, which wasn't sustainable. So for 30 years, no exploration, 25 years, no new uranium mines were built. So if you look at the industry is old and tired. There are not many new mines. So as I said, Langheinig was the first new conventional uranium mine started anywhere in the world in the last 25 years. There's not technology available, so engineering, all that side's a problem. If you come to what's sustainable in a price, you don't need $138. The long-term price at the moment is between $75 and $80. For our scoping studies and feasibility work, use a price of $65 US. Just like gold, if the gold price is $1,000, you can probably work a gram of gold. Uranium is different because it's a long-term supply, so you can't just make uranium for no reason, because what do you do with it? So that's why a lot of the mines closed when the uranium industry collapsed, because they didn't continue. I'm talking about the 70s and 80s, because they didn't build more nuclear power plants.